How will the bankruptcies of TGI Fridays and Hooters affect the credit markets for restaurants? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business, and this week's episode of A Deeper Dive is all about the credit markets and specifically whole business securitizations and how the aforementioned bankruptcy filings will affect that market. I'm joined this week by Ed Cerullo, a credit analyst with Octus, who looks at distressed debt situations. I wanted to talk to him specifically about the securitization market. A whole business securitization is a very popular financing instrument in the restaurant space. It uses a company's cash-generating assets to back bonds, and Ed helps explain how this works far better than I could. Both Hooters and TGI Fridays use this type of financing. We talk about whether credit rating agencies that rate bonds for these whole business securitizations adequately accounted for just how much risk these companies were taking on. We also talk about whether the securitization process is actually encouraging more risky behavior, sound familiar, among borrowers, and how the bankruptcies will affect this market. We're talking credit on Deeper Dive, so please check it out. All right, I'm here with Ed Cerullo. Ed, welcome to the podcast.
Thanks for having me, Jonathan.
All right, cool. Tell us a little bit about yourself, Ed.
Sure. I'm a distressed debt analyst at Octus, which is a provider of credit intelligence to the broader credit markets. Mm-hmm. I've been doing that for about 5 years now.
All right. So the primary topic today is on whole business securitizations. Without putting the audience to sleep, could you explain what that is?
Sure. I'll try to unpack it for you as best as possible. And why don't I first start out by breaking it into its two constituent parts in the name. That is whole business and securitization. Securitizations have been around for pretty much ever. And in its most elemental form is a financing construct that relies on receivables or any form of cash generating asset or revenue generating asset as a source of repayment by essentially isolating or ring fencing those cash flows for the purpose of raising funding. Now, what do I mean by cash generating assets, specifically in the context of the restaurant business? I'm referring to franchise and licensing fees. I'm referring to royalty payments and streams. I'm referring to company owned and operated store operating profits. I'm referring to real estate. And the most important thing about those cash flows is that they're contractual and recurring in nature. And that's what sort of the securitization or the asset-backed security market likes. They like cash flows that are stable, that are recurring, and that are backed by contracts to perpetuity, effectively. So that's, in a nutshell, the securitization part of the name. Now, where does whole business come into play? Oftentimes when we hear securitization, we think of tranching and slicing and dicing assets and carving out specific revenue streams, say a geographic segment of stores and their underlying royalties. The whole business construct simply refers to ring fencing and isolating the entirety of those cash flows of the business. That's all the royalties, all the operating profits, all of the licensing and franchising fees. And that's why they're often referred to as corporate securitizations, because they entail all of the assigning, conveying, and selling all of the corporation's revenue generating assets into a lockbox account that then issues debt. And that debt is serviced by those cash flows. So in a nutshell, that's what it sounds like a fairly esoteric and complicated financing structure, but it's really one that is simply a receivables-backed financing vehicle.
Yeah. So they create this shell company and then transfer their assets. And the shell company, of course, usually has a name that was clearly made by a financial officer of some sort, because there's no creativity whatsoever in these. It's probably something like Hooters Funding or something along those lines. Transfer the assets, and then they manage the assets under contract, which basically just means they continue to operate the company like they normally did, unless something extraordinary happens, which is the reason why I'm bringing you on this today, because we've had a couple of these situations. The first thing I want to ask, so I'll get back to the explanation though, is they still require investors to buy bonds for the securitization. So you still have to make investors happy to an extent, or give investors confidence that this is going to work. That's a key point, is it not?
Yeah, absolutely. I think one of the things that, if you question why whole business securitizations, why is Hooters, why is TGI Fridays employing this seemingly esoteric securitization structure to finance its business? Why isn't it not just using the unsecured or secured debt markets to issue corporate debt? Why is it not tapping the leveraged loan market for, secured loan? And to get to the bottom of it, really is it's quite simple. It's the cheapest form of capital. It provides the lowest cost for the company in terms of the interest rate that it pays on that debt. And simply put, the reason why it's the lowest cost of capital and the cheapest is because it is rated the highest. There are these rating agencies that are in the business of rating debt, and they confer either a junk status or a investment grade credit rating status to your debt. These whole business securitizations are all structured to investment grade. That implies infers a lower risk profile as an investor in that security, as an investor in that debt, an investor in that paper. And not to get too into the weeds, there is something, there is something behind that, that structure that confers it a greater degree of security to the investor. The three main things, the three main sort of hallmarks of a whole business securitization, this process of selling your assets, selling your right to receive royalties. What you're essentially doing is if you're investing in that structure, you're as close as possible to the asset. Every single dollar that goes into the SPV, every single collection, whether it be a royalty or a company operated for profit, in its most simplistic state, any dollar that goes in there goes to service the debt. And there's a waterfall structure. There's an order of priority of payments, and I don't get too in the weeds on that, but you're as close as possible to the asset, and therefore it's a more secure instrument. The second thing is that you're also legally separating those revenue streams and those assets from the parent entity, from the original operator, from the the Hooters of America parent. And by doing so, you're creating this bankruptcy remote entity that is and establishing this corporate separateness. The theory behind that is that if Hooters of America or TGI Fridays as franchisor or an originator files for bankruptcy, you have this bankruptcy remote structure, and it will preserve the continuity of those cash flows into that structure. So if and when that parent company files, the investors of the securitization vehicle will have an added degree of protection because they have sole claim. They have the first priority claim. They have a sole claim to those assets. And then one additional hallmark or feature of these whole business securitizations that adds to the creditworthiness of the structure, or it should at least, is that there are these structural features that are baked into the transaction that corporate debt doesn't have. So say, for example, system-wide revenues fall by half, or collections into the securitization vehicle fall by a certain percentage. There are these automatic triggers such that every single dollar that flows into that account automatically goes to amortize and repay that debt for the benefit of the investor in the securitization. So that's why, in a nutshell, these structures get rated higher than, say, the unsecured or secured corporate debt that these companies would have.
Right.
If that explains it.
Yeah. So we had two separate situations here involving TGI Fridays and Hooters, and both of which were fairly extraordinary. And, because one of the things that you mentioned was protections put on, that features some protections for the investors into securitization, which essentially enables the debt to be offered at a lower cost. For the restaurant companies, and of course, restaurant companies absolutely love these things right now. Or have in the last few years and have been, in fact, if you just name some random large franchise business, doesn't matter what it is, they probably have it as securitization. Subway just did a really
I have
big one.
the numbers for you. There were 11 or 12 deals this year alone that 2024, and they raised over $10 billion of dollars.
Really? Yeah.
So yeah, the who's who of restaurant franchises have issued that debt, and all of this whole business securitizations are done by restaurant brands.
Yeah, they love them, and they've loved them for a while, but it just seems like they've been doing it like water. But one of the protections is on the manager. So what we saw last year, and I'd never heard this term before, and I've covered restaurant finance, Ed, for close to 20 years. That's what I'm putting in that. So I've covered this for a while. I'd never heard of a manager termination event.
Yeah.
And then we had that happen last year. So I had to look it up. And explain that situation.
Yeah.
Like that's, you had Fridays essentially lost control of most of the assets, which is
It
just
lost
insane.
control of its business. Yeah, it lost control of its business. It failed as its fiduciary duty and responsibilities of managing and maintaining the value of the trademark, maintaining the value of the brand, and resulted in a manager termination. But in a nutshell, when TGI Fridays, as originator, as operator of this franchise system, sells the right to receive royalties and company operated store profits into the securitization vehicle, in order to ensure that those cash flows continue to perpetuity or are maintained at a reasonable level that can service the debt. TGI Fridays or Hooters has to maintain the value of the brand. They have to invest in research and development and sales and marketing. They need to manage the centralized purchasing of the system. And they need to manage the value of the brand. They need to license and sub-license the IP in furtherance of the brand, and are tasked to do so as manager of the securitization, which essentially is doing what they're doing all along. Now, there are certain, again, I talked about these structural triggers. If the manager is failing, its responsibilities to the brand, ultimately, to the franchisees, to the system, and to the securitization, it can be removed. And in effect, what we saw in the case of TGI Fridays was really interesting, because TGI Fridays was actually over. So I simplified it earlier and I said, like, every dollar that goes into the structure goes to pay the debt. In reality, about 35 cents, up to 35 cents goes back out to compensate the manager for its services and role. And TGI Fridays was actually overpaying itself. It was paying itself more than the underlying debt documents legally allowed it to extract. And the reason why it was overpaying itself was because, in addition to managing the franchise system, it also had 39 stores outside of the securitization and outside of its that it owned and operated. And those stores had past due accounts with vendors, and TGI Fridays needed to pay those accounts. So they were extracting money out of the securitization, away from the investors in securitization, away from the franchise system, and investing in the value of the brand to address these past due accounts. And that was, suffice to say, that led to or precipitated a manager termination event, and emphasized the importance of the role of manager of a system, particularly in the context of whole business securitization, protecting and ensuring the continuity of the cash flows, the liquidity both for investors and the value of the brand. And it failed to do so and was removed as such. It also poses another issue: is, well, who's going to step in? Right? This concept of backup manager. If TGI Fridays can't do it, well, who's adequately equipped to step in? And there's this concept of backup manager, and you generally have a consulting. I think it's FTI Consulting, in this case, stepped in and fulfilled its role as backup manager. But that was you're right in saying that was a unique instance where the TGI Fridays lost control of its brand. I think it was the first time it had occurred since the financial crisis, which was sort of the last time around when securitizations was a big buzzword and whatnot.
Yeah, it had been 15 years since something like that has happened in any industry, and I hadn't seen it happen in the restaurant space. The other thing that hasn't happened in the restaurant space is a bankruptcy. And now we have seen two. And this basically, my biggest question is, like, look, we've had now, 2 bankruptcies in this market. We had the manager termination event, a complete disastrous situation over at Fridays. Is this going to color the market? How is this going to influence the market for these securitizations in the restaurant space?
It's a great question. I think there's, I mentioned the financial crisis. I mentioned the rating agencies. The rating agencies and the securitization product was kind of tarnished and maligned. There was this view that that securitization was sort of minimizing and dispersing risk and reducing it across the system. It turns out it was actually enhancing it, and the rating agencies were slow to respond. There were, these multi-notch downgrades overnight, and there was very little trust and faith in these structures. And I think there's an element to which, rating agencies may need to recalibrate their models in terms of, one, are the structural protections that I mentioned sufficient in the downside scenario? Are they stress testing what a downside scenario looks like? And are the ratings justified? Should these structures be garnering the investment grade rating that they're receiving? It also begs another question: is this financing model fit for purpose? For the restaurant business, whether it be a franchise model or a company owned and operated model. And I think there are elements, like I said, that lend itself to the product. There's this securitizable series of cash flows that you can legally isolate and separate and create this lockbox structure. And it should serve to preserve the continuity of those cash flows in a distressed or bankruptcy scenario where you have a manager termination event. In reality, does that actually occur? Do the structures address the problems that they seek to solve? And you could argue that in certain cases they don't. If you look at here's a hypothetical example. We talk about this manager fee and the role of the manager. The whole business securitizations effectively cap what a manager can, the size of the management fee. There's tend to be formulas, and there's a fixed component and a variable component, but ultimately it's no more than 35% of the collections that flow into the structure can go back to pay the manager. So take a downside scenario where system-wide sales fall, collections fall. Intuitively, therefore, the management fee falls. But in reality, if you're operating a business that's in a downturn, you're going to want to invest more in sales and marketing. You're going to want to invest more in research and development. You're going to need to implement sort of counter-cyclical measures. These structures don't afford an operator that degree of flexibility. And I think that's where there's this rigidness that makes it, particularly in downside scenarios, very difficult for these companies to manage their operations. And in certain cases has resulted in, the removal of the manager as such. I'd argue that what Hooters is trying to do and effectuate through the bankruptcy process may address some of these issues. Based on sort of my preliminary understanding of their restructuring support agreement and what they're intending to do and pivoting or transitioning to a pure franchise model, they're also sort of cleaning up the structure a bit. They're essentially saying, look, there's going to be one entity that collects the royalties for the purpose of securitization. There's going to be another entity that collects the other half of the royalties to manage the brand. And then the franchisees are going to run their franchisees because that's what they do. And I think that's maybe, sort of a better model going forward than what we've seen, where just everything flows into a lockbox. Some of it gets paid out. Some of it gets overpaid. There's, the TGI Fridays parent also operates stores, has these other interests at heart. The securitization investors have their own priorities and the franchisees have their own priorities. So it can get really complicated and really messy. And we've seen that. And we've seen these two bankruptcies.
Yeah, for sure. I mean, I have a number of concerns about this. My biggest concern, I think, especially if you look at the past few years and how these have been used. Well, first off, on the Hooters thing, I think a lot of what they're doing now makes some sense. Like, to be honest, what this bankruptcy is going to do, oddly enough, is fix Hooters. Because Hooters had just a messy structure dating back to 2009. And it should never, and probably years earlier, but the guy who done it actually was really good for the brand. But it should not have been operated in this manner. And so it's probably fixing it, and with a group that probably cares a lot more about the brand than other people, which is actually a really good thing. But on balance, like, look, I mean, if TGI Fridays, and part of my concern here is that the companies, a lot of the companies that are going out to the debt markets, and it's not just like TGI Fridays. TGI Fridays in 2021, my guess is probably didn't have that many option, or it was Hooters that went in 2021. I think it was Fridays a couple of years before then.
Preceded that, yeah.
But neither of these companies, when at the time they went to the securitization market, was what you would call a grade A borrower in the restaurant space. These are, in some respects, part of me. And another company that I have concern about is Fat Brands. Like Fat Brands, and that is a pure franchise play model, but still, you got these companies that are going to the bond markets or that are going to the securitization markets, and they don't really have a business model. I mean, they generally tend to have flawed business models. The casual dining sector has been in decline broadly for 15, 16, 17 years, ages. And so you can probably set a timer on some of these things when you're going to have some particular issues. TGI Fridays going into the pandemic was having challenges already. Hooters has had historic problems and things like that. That's my concern with these, is that they and then they end up getting these good credit ratings that's starting to creep me out. Actually creeping me out, period.
Yeah, no, absolutely. And a lot of companies, they see these improved rates at which they can borrow, and they think that's because of the underlying business fundamentals and their creditworthiness, and not this structure. Again, I'd go back to the fact that these structures are meant to mitigate some of these risks. They're meant to. For example, there's a really long maturity tail. So a lot of these structures have a legal maturity that goes out 20, 30 years or even longer. The idea being that they don't need to be repaid. The principal doesn't need to be repaid immediately. It's not a 5-year corporate bond that has this bullet maturity. Typically the level of cash flow coverage, the cash flows that go into the lockbox in order to service the debt tend to be more than ample and sufficient. I go back to the point that, are we adequately sensitizing to the downside? And are the triggers set at the right levels? But absolutely, we're two bankruptcies in as many months practically. Arguably, yes. I think I agree with you. What Hooters is looking to effectuate and sort of transition to the fully franchised model and clean up their structure, I think, is ultimately what it needed to do a long time ago. An interesting feature of these two parallel bankruptcy processes is that harped on about how these whole business securitizations are bankruptcy remote, and they're structured as such so that the underlying investors are protected from the bankruptcy of a parent. Well, if you look at Hooters, the securitization vehicle actually filed for bankruptcy too. So that securitization vehicle is one of the debtors in the bankruptcy process. Now, there's a nuance to it, because I think they're doing it so that they can raise DIP financing and funnel the DIP financing through that structure. But it's like, okay, you've gone through this entire process. You structured this really complicated instrument in order to raise cheap funding and probably a larger quantum of funding than you could have otherwise accessed, and to create this complicated structure. And then it's just going to be thrown into the bankruptcy process as well. So that was a quirk of the Hooters case that I didn't necessarily expect. Some of my colleagues on the legal side didn't necessarily expect. There's very little case precedent for whole business securitizations in the context of a bankruptcy. How do they fare? What's the treatment of the structure? Who gets paid what? The securitization is the entirety, is the bankruptcy effectively. So how can that be outside of the structure if it represents all the company's assets and the preponderance of its debt? So it definitely poses a lot of interesting questions. And yeah, to your point, even with these structural mitigants in place, to protect lenders, to seemingly help the company navigate downside scenarios, the structures still sometimes fail. And you'll see there, the TGI Fridays, the most senior tranche has been paid off, but I think the junior tranche is still outstanding. And the debt service coverage ratio, or the degree of cash flow coverage in the securitization vehicle, is very low. It barely covers interest and principal payments at the moment, and is in this rapid amortization event. The same with Hooters. So it begs the question: if these structures unravel so quickly, should they have been rated investment grade to begin with? Should these companies be employing them? Who's ultimately at fault? Does it harken back to the financial crisis, when securitizations were being hyped up as this tool to diversify risk and to tranche up risk and to ultimately reduce the level of risk in the system, when in fact is actually creating more. And it could be argued that's an element of what we're seeing here.
To me, it's hard to look at this. It's hard to look at these two situations and not think that, to me, like, if I just look at them as somebody who's been looking at this industry for a while, and it's also fair to point out that certainly in the Fridays case, there was a pandemic that happened in the middle of it,
Mm-hmm.
not in the Hooters case.
Mm-hmm.
The Hooters was post-pandemic, but you're still looking at, these two are just fundamentally riskier. That's the reason why they're going to the securitization market in the first place, because they're if they go on the if they just go out and get securitized debt, their costs going to be a lot higher because of who they are and where their financing is going and the amount of debt that they were looking at getting. So it's hard for me to see how the securitization market isn't encouraging this sort of risky type of behavior in these types of markets. And again, I'll say this: with Hooters, what the Hooters doing now probably should have been done 15 years ago. It's still I mean, you're putting some of these investors, financing at risk. These investors are taking a look at the ratings that these bonds have, and they're like, oh, well, we'll take care of that, and they have some downside protection for sure. But
no, absolutely,
yeah. Go
I
ahead.
think it speaks to, and something that we at Octus we talk about a lot is the the financialization of certain industries, and this is an example of that. This is a relatively esoteric product. It's inflexible in certain respects. It doesn't allow a degree of discretion when it comes to how money is being spent in furtherance of a brand, and sort of maintaining the value of that ultimately the IP that underlies the ability of that company to generate cash, and there's a real risk to that, and I think we've seen it in these cases, and so yeah, these are the first. There will be more. I'm not a restaurant sector or quick service or casual dining sector specialist, but I'm as a financial analyst, when we're looking at these structures, we love seeing or looking at how they actually perform, whether they do what they're intended to do, and how they, especially in a downside scenario, especially in the context of a bankruptcy, how they serve to preserve value or don't. And so this is the two very interesting case studies. There are parallels and also nuances to both. For example, TGI Fridays, that whole business securitization is completely outside of the bankruptcy structure.
Right.
So those entities did not file for bankruptcy, whereas in the case of Hooters, they did. Again, it's sort of related to the nuance and what they're trying to effectuate through the bankruptcy process. But there's still a lot to be learned about how these structures perform, how they could be improved. Should these companies be employing them as a financing method, and how they affect the various stakeholders and constituents, whether it be the lenders, the operator of the franchise, and or the manager of the franchise and the operator of the stores, and how ultimately the licensing of the brand is being used.
Yeah, so it won't be the last.
Mm-mm. Mm-mm.
Oh, that's disturbing. Ed, this was great. Really appreciate you helping us out and joining us this week on the podcast.
Absolutely. Thanks for having me.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons, artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.